portion of the code is 32. I'll now turn our webinar over to our speaker for today's event, Ray Antonelli. Ray?
Thank you, Andrew. I appreciate that. So the subtitle, if you will, of the webinar today is What to Do When the Bank Says No. And this is going to be a presentation of what you need to know to let your clients know the best methods for getting cash into their business for any purpose that they might need. A little background on me. I've got 16 years in the lending arena of all types, mostly primarily residential mortgages. However, during the past 3 years, I've also expanded into unsecured business lines of credit, which will be the main topic of the webinar today. Prior to this, I've also been an investor in real estate, and just this year I was named one of LinkedIn's top 100 real estate professionals in March of this year, as a matter of fact. I have previously conducted webinars and seminars in person for the Ohio Society of CPAs, and in August I'll be conducting a 10 Steps to Perfect Credit seminar, or webinar I should say, which you will be invited to attend as well. Most of the slides have my contact information on there, so if you need to reach me for any reason, if you have questions, don't hesitate. I'll be happy to help. Okay, so again, what to do when the bank says no. There are many ways to finance investments, of course. Local banks is one of them. Family, of course, is another. Friends, crowdfunding, retirement accounts, many different ways. Okay. Also, unsecured business lines of credit is another approach with many advantages. So borrowing from banks, let's cover that for a little bit. Typically, when you borrow from a bank, it requires really great credit, lots of income, usually requires collateral of some type, and most lenders require annual requalification, and of course restricted asset types. Okay. Now, let's take these in order. Great credit typically is scores above 700, okay? As most of you know, the whole range of credit scores goes from about 350 on the low to about 850 on the high. And generally speaking, when your scores are above 700, and about roughly 25% of the population has scores above 700, you can pretty much do what you need to do with respect to credit. Lots of income. Most banks will not allow any loans for someone, even if they have great credit, unless they demonstrate the ability to repay the loan. Okay, and also loans from banks usually require some type of collateral. For example, most of us are familiar with HELOCs, which stands for Home Equity Line of Credit. In many cases, the bank will make a loan or of some type, either a credit line or a mortgage loan or whatever, as long as the collateral of the borrower's personal residence is involved. Also, I know of some banks who, even after making that type of loan, require annual requalification. So in January, at the end of the year or the beginning of the year, you have to bring in your tax returns, you have to bring in your balance sheets or income statements to make sure that you still qualify for the loan ongoing. Okay, and then of course there's also restricted asset types that is another possible complication when you borrow from a bank. I had a gentleman who had scores in the mid-750s, you know, very good scores, and wanted to go to a bank, and did go to his bank to borrow funds to buy a food truck. Okay, and the bank turned him down just because it was the wrong asset class. As you may know, most banks do not want to loan on food service because usually the risk of going out of business in food service is much greater than it is for most other types of businesses. Okay, borrowing from family and friends. It's usually much easier than other types of borrowing. Obviously, there's usually not a lot of paperwork involved. It would be a good idea if there was paperwork, but it doesn't always happen when it's family and friends. The approval or denial process, if you will, is usually much faster, but it's not always good for the relationship. as all of us know, family dynamics can range from really, really good to pretty terrible on the bottom end, and obviously throwing money into the mix tends to complicate the relationship even more. Even if everything is on an even keel with respect to borrowing from family and friends, however, it's limited by the funds that any family member might have available to lend. Borrowing from retirement accounts is pretty easy to do. Of course, you need funds in the account in the first place, okay? Usually just a phone call and a signature is all that's required. And of course, most retirement accounts do have penalties for early withdrawal, or restrictions in some cases. For example, I know many people who have 401ks or a similar type of account through their business, but they're not allowed to borrow funds unless it's for a specific issue, like, for example, a down payment on a house, for example. And of course, there's usually tax consequences, usually negative tax consequences for borrowing from a retirement account before you're actually retired. Crowdfunding is another source that has received a lot of press recently, okay? There's some disadvantages, however, to crowdfunding. The time to receive the actual funds is usually measured in months, okay? It's not something where if you qualify for a loan, you go down to your local lender and you get a check usually within a week or so. Usually it takes quite a long time. Most campaigns are not successful or raise significantly less than expected. That's also an issue. Probably over half of the folks on Kickstarter or other crowdfunding websites like that are not successful in raising the dollars, and some of the websites actually will not even allow you to raise less than your stated amount. So in other words, if your goal is 50,000, let's say, you only raise 45,000, they return the 45,000 to the contributors and you get nothing. Okay, so that's also an issue. It seems like crowdfunding is better for consumer products than private lending. For example, if you're developing a new widget, like the biggest thing in the news was the guy on Kickstarter who was developing a watch. Okay, obviously a watch that connects to the internet and so on and so forth, and he was way oversubscribed. He raised millions of dollars and then had trouble actually delivering the watches on time. So there's a lot of pitfalls in that respect. So unsecured business lines of credit is another type of way to fund business operations or investments that has advantages and disadvantages, but most of the time they're advantages. Number one, it's fast, usually less than 30 days from start to finish. So for example, if I have a credit report in my hands that I can analyze today and I approve it, okay, and today is the 24th of July, then by the 24th of August, the client has credit lines in their possession that they can use, okay? Only great credit is required. That's another unique thing about these unsecured business lines of credit. The only two things that the underwriters verify is your credit report and your federal tax ID or your EIN, okay? Everything else is basically stated. Our application is also only 9 pages long. If I were to do a residential mortgage, obviously most of you have done residential mortgages in the past or have seen or participated or have a residential mortgage. If I have done that, then forgive me. Then you've seen that we kill a tree for every mortgage that we do. You know, there's usually a stack of paperwork that's inches thick, whereas our application is only 9 pages long. Also, our space is usually, our lending space is usually from 50 to 250,000. Obviously, if there's any two applicants, like husband and wife or business partners or whatever, and they both have excellent credit, then up to $500,000 is possible to do. All the credit lines have 6 to 12 months interest-free, which is another big advantage. And the other, so for example, I obviously target the real estate investing group because they're not the local banks or any banks that do mortgages are typically not friendly to investors at this point. It's conceivable that an investor might have to put down 30% for any non-owner occupied purchase that they want to make, plus the closing costs. And then, of course, they have to jump through hula hoops with respect to income as well, and are usually limited to between 4 and 5 mortgages with any one lender to boot. So it's possible that some real estate investors who use these lines of credit to buy, fix, and flip a couple properties can typically do at least 2 of those deals within the 6 to 12 months and not pay any interest at all during that initial period. These credit lines also only report to the business credit profile, and that's important as well because, as most of you know, if you max a credit card limit, your score could drop by as much as 50 points even if you're paying perfectly. And that's not true with business credit. With business credit, the only thing that matters is whether the client is paying on time. Some of you know that there's a whole range of functions that determine what your credit scores are on the personal side. On the business side, that's not true. You typically can pay on time and have a good score no matter what the debt ratio is or the credit utilization ratio is on each individual line of credit. And also the funds can be used for any purpose with respect to the lines of credit. So knowledge is power. Okay, I very much encourage everyone, including all of us, to get a copy of their credit reports and scores at least once a year to check for errors. It's very common for credit reports to have errors. I teach a first-time homebuyer class also, and I also counsel them to get a copy of their credit report a minimum of 90 days prior to them starting to look for a home, because if they do find stuff that needs to be corrected, it can take as much as 90 days for the correction to show up on credit. And the site I recommend for everyone is www.creditchecktotal.com. And for $1, you get all 3 scores and reports. Credit Check Total is run by Experian, one of the 3 big credit reporting agencies, so we know it's on the level. Okay. Now, when you go to that website, you sign up for $1. And if you do nothing, it automatically converts to credit monitoring for $30 a month. Now, the credit monitoring itself is one of the best out there that I've analyzed. Obviously, you get online access to your credit reports 24/7 and scores at any time. And the other neat feature is whenever there's any change in your credit report, you get an email. So it's almost like identity theft protection, because if you're not applying for credit and there's a change in your report, you need to know what's happening there. Okay. Now, if you do cancel within 9 days, they automatically offer that program at half price, $14.95 per month instead of $30 per month. That's the number to sign up for. $14.95. It's a good value, and they provide a good service. Beware of the ads for a free copy of your scores. Some of them are outright scams, and I'll give you an example of this. The government-sponsored website, if you will, is annualcreditreport.com. And all the 3 big credit reporting agencies fought that law tooth and nail before it actually was enacted. And then after it became law, they turned a lemon and made lemonade out of it. Okay, so now they do give away the free reports as required by law. However, they charge out the wazoo for the scores. Okay, they make millions literally millions per year on the scores alone. In addition to that, there's at least 3 different score models as well as 3 different credit bureaus. So for example, the online scores are the highest, the auto and insurance scores are in the middle, and the mortgage scores are the most conservative. Well, why is that? Well, typically it's a lot easier to repossess a car, for example, than it is to foreclose on a house. So that's an example of why the mortgage lender scores will be the most conservative out there. Here's a credit score pie chart to go over. This is, we're not going to spend a lot of time on this, but it's something that you do need to know. The payment history is equal to 35% of the total credit score. We're talking about consumer credit now, okay, not business credit. The payment history is equal to 35%. So that means if you pay on time, you're golden, okay? Now, one thing you should be aware of is that when you pay on time, a lot of people will come to me who are looking for a mortgage, for example, and they'll say, well, geez, I have less than perfect credit because I've paid late a few times, okay? And when I check their credit, I find out they have perfect credit. And here's the reason. The creditors can only report you late to the bureau if you're 30 days or more late, okay? So if you happen to be 10 days late or 15 days late, you pay the late fee and you make your payment and everything is fine, okay? You think you have bad credit, but in reality, unless you're 30 days or more after the due date of every monthly loan, okay, they can't report you as late to the credit bureau, okay? So payment history is more important than anything else. If you pay on time, even if you've had previous problems with your credit, as long as you pay on time for a couple of years, you're going to find your score will go up. Then amounts owed at 30%, that's also a key, all right? So the easiest way to explain that is if there's 3 credit cards, each with a $5,000 limit, and a client owes $4,500 on them each and paying perfectly, their scores are probably going to be in the low 600s. You take that same client who pays off or pays down on those credit cards, so each $5,000 limit also has only maybe $1,000 or $500 owed on it or nothing, the scores are going to be in the 700s. Okay, so that's how dramatic the amounts owed can affect the credit score. So those 2 things, amounts owed and payment history, equals 65% of the total credit score, and obviously have a direct impact on how good or bad the credit looks. Length of credit history, 15%. Give you an example. I have a BP Sohio credit card in my wallet. For those of us with gray hair, we remember Sohio. And I've had that since 1976. So all other things being equal, I've got a really long history in the credit bureau, and that helps my score be higher. Okay, new credit at 10% is almost a negative. Okay, new credit is the amount of times someone pulls your credit. A mortgage professional like myself pulls your credit. 1 or 2 every 6 months is okay. However, I've seen people with 15 or 20 credit pulls in the last 12 months, and that definitely raises a red flag on the part of an underwriter. Types of credit. It benefits you if you have multiple types of credit. So, for example, a mortgage loan, credit cards, a car loan, installment loan of some type, etc. That's what types of credit means. Okay, with respect to unsecured business credit lines, again, there are no upfront fees. We only collect a fee if we are successful acquiring credit lines on behalf of our client. So the client has to have those credit lines in his possession before any fees are collected, and the client can actually pay our fees right out of the credit line. They do not have to come out of pocket with any cash. Okay, cash within 30 days of application. The initial goal is between 50 and 100K in 30 days, and it's usually less. Okay, so typically the client's credit is what determines exactly how much they qualify for. So, for example, if I have a client who has no late payments at all on his credit or her credit, And then they have few or no credit pulls in the last 12 months, okay? And they have high credit card limits and low credit card balances. That's also a good goal. And they have gray hair when they apply. Having gray hair is a plus. Typically, we look at college students who just recently graduated, have a couple of credit cards, scores in the 700s. Typically, they don't qualify for lines of credit because the underwriters are looking for a minimum of 8 to 10 years history in the bureau before they are granted lines of credit. Okay, so the client typically qualifies between 50 and 100K in the first 30 days. Okay, if more than 100K is desired, then we simply rinse and repeat. So what has to happen is the fresh inquiries created by the first round of funding have to be cleaned off. So we refer our clients to a third-party company that is an expert at getting inquiries removed from the credit report. That usually takes about 30 days, another 30 days, and then after that process is through, we usually apply again on their behalf to a completely different set of lenders to get them additional lines of credit. Okay, so 200K is usually possible within 60 to 90 days total, again with really great credit. Okay, and as I mentioned at the bottom here, cleaning the fresh credit inquiries will be necessary between the first and second funding rounds. Again, that's one of the key things that the underwriters look for. If there's a bunch of fresh credit pulls on there, the underwriter's going to say, well, gee, what happened there? Did they qualify for credit or other credit? Is that going to affect their debt ratio or what have you? So that's why the credit inquiries need to be cleaned off. So there's no impact to personal credit. Other than the initial inquiry, there is no impact to your personal credit reports. So that means this is, again, referring to the fact that the business lines of credit report to your business credit profile, generate payback scores rather than your personal credit. So the only thing that shows up is the inquiries, and if there is a need, we can get those inquiries cleaned off, as I said, in about 30 days or less. So these are true lines of credit, okay? No collateral is required and no mortgage is given. When the line is paid back, it's available again for reuse, okay? So when the line is paid back, the balance goes to zero, the interest goes to zero, and the funds are available to borrow again. So it's perfect for example, a fix and flip scenario if you happen to be a real estate investor. And as I mentioned, if the line is at zero, the interest is at zero, and you do not have to requalify every year like is typical for a home equity line of credit, forgive me, for a line of credit that is tied to your home. Okay, it's available to all business entities, including sole proprietorships, C Corps, S Corps, LLCs. The applicant does not need an existing business to qualify. So this business can be brand new, provided they have their federal tax ID or their EIN. Okay, and it's not a situation where the business has to be 3 or 4 years old, typically like it does for local businesses when they go to a local bank to get a loan. Okay, and new businesses merely state their income based on the projections. So when I have, for example, a new real estate investor who is looking to borrow funds, they incorporate, and they actually state what they think they're going to make if the credit lines are approved. Okay. Okay, minimum monthly payments. Typical, the monthly payments on these lines of credit are 2% of the unpaid balance, similar to a credit card. So, for example, if you borrow $50,000 and that's the unpaid balance, your typical monthly payment on that is about $1,000 a month. That's roughly 2%. And that means that obviously it's going to amortize over a 4 or 5 year period if you do nothing else, if the balance doesn't change and your minimum monthly payment doesn't change. Obviously, if you have a $50,000 mortgage over 30 years, the payment's only going to be a couple $100 a month because obviously the amortization is stretched out over 30 years as opposed to 4 or 5 years. So this is a relatively fast payback on this loan. Okay, the requirements to qualify are stringent. Again, only about 25 or 30% of the entire population will qualify for these types of loans. So you need minimum 700 scores in all 3 credit bureaus. And as I said before, at least a 10-year history. And 15 or 20 years is even better for a history. So when I analyze a credit report, I look for credit cards that were opened, prior to 2005, for example. Actually, prior to 2000 would be even better. Okay. Now we're bordering on a 15-year history or a 20-year history, and that's a strong pull for the underwriter. You have to consider the fact that if the underwriter only has to verify the credit report and the federal tax ID, they're going to microscope the credit report to determine whether this is a really good candidate or not. So no negative items on the credit report. No late payments at all is preferable. No bankruptcies, no foreclosures, judgments, collections, etc. Okay, we want to see obviously no 30, 60, or 90-day lates as well. We prefer no negative items at all. Now, I do have access to a pretty reliable and low-cost credit repair company, and some minor issues might be able to be cleaned off before the start of the application process. Okay, preferably high revolving limits, 20,000 or more. I use the example of my ideal candidate having a $25,000 limit on a credit card, only owes $2,000 or maybe nothing, but used to owe $20 and paid it back. Okay, that tells the underwriter that this client knows how to manage large sums of debt responsibly. Okay, and they typically will qualify for the larger credit lines. Low credit utilization, 30% or less. Okay, so looking at all the revolving debt or credit cards on the client's credit, if they have a $10,000 limit, they can't owe more than $3,000 on that card at the time of application, or if it's a $5,000 limit, $1,500, etc. Okay, so again, those are solvable issues. If the client has a lot of judgments or collections or what have you, those are much more difficult to fix, issues to fix, compared to high balances on the credit cards, that sort of thing. So the underwriter is going to look for 30% or less credit utilization. Now, guarantors are freely accepted on this program. So what that means is, let's say, for example, the husband's credit is not quite up to snuff, but his wife's credit happens to be, exactly what we need. Well, there's no problem if the wife does not have a job outside the home, because, again, the income is stated on this program. Okay, so what happens is the wife steps in and qualifies for the husband. The spouse steps in, qualifies for their partner, and when the accounts are set up, the company name is on the account plus the name of the guarantor. And so, for example, if the wife qualifies, but the husband is the one who's going to be have access to the funds, when the account is set up, then they simply call up the lender and get another set of cards or access to the account sent out for the husband to use.
Ray, let me go ahead and interrupt you here and just say the middle portion of the code.
Absolutely.
All right, the middle portion of the code is 11. Again, that is 11. All right, Ray, back to you.
Thank you. Okay, as I mentioned, the credit requirements are stringent, and these are basically the key qualities that the underwriters look for. No lates of any kind on the whole report. 1 or 2 isolated 30s might be okay, but it'll definitely impact the size of the credit lines at the minimum. Okay, 8 years minimum history for revolving debt, credit cards. Longer is even better. Again, I really jump for joy when I see credit cards that were opened up in the mid-90s, because then I know we have a 15 or 20-year history in the Bureau, and underwriters really like to see that because obviously it indicates stability. If someone has had an account open since 1995, for example, this is 2013, so they've paid on time for almost 20 years, that makes the underwriter feel warm and fuzzy about the fact that if they grant them a credit line, they're going to pay the credit line on time as well. So no or low credit pulls in the last 12 months. Now, typically in the course of a year, you might have 1 or 2 credit pulls every 6 months. That's kind of normal, okay? However, I've seen clients who have 15 or 20 credit pulls in the space of the last 12 months, and that's an automatic turn down unless they are cleaned off. And as I mentioned, we have a third-party company that we can refer these clients to get them cleaned off. That process takes about 30 days. Okay, number 4, high credit card limits and low balances. The balances can be no more than 30% of the limits on all cards. We mentioned this before. If a client has a $25K limit but owes nothing, but used to owe 20, that tells the underwriter that this client knows how to handle large sums of debt responsibly, and they'll qualify for larger credit lines. Now, if someone has only a 10 or 15K limit on their cards, they'll also qualify, but instead of qualifying for as much as $100,000 in credit lines in 30 days, they might only qualify for $40,000 to $60,000 up front. Okay, and then they can go through the same process as the client who qualifies for more and have their inquiries cleaned off, and then we go to the bat for them again and get them an additional sum of credit lines above the $50,000 or $60,000 level. Get them, over $100,000 in the second round of funding, for example. Okay, unique features. Again, the initial interest-free period upon receipt of 6 months to 1 year. Now, the rates for unsecured debt are actually fairly low. Okay, let me give you an example. The 6 month to 1 year period is from the receipt of the card. So a lot of people will ask me, well, gee, does my grace period start the moment I use the card or the moment I receive it? And the answer is the moment you receive the card is when the interest-free period begins. So that's an inducement for you to use the credit lines, start using the credit lines as soon as you get them to take advantage of that interest-free grace period. Low rates for unsecured debt. Now, the interest rates after the 6 to 12 months period is typically going to be between 7 and 15%. Now, if the client gets any interest rates above 10, we can teach them how to easily get those rates back down into the single digits. And it's really not hard to do. 99% of the lenders will play ball. Let's say, for example, that the client has an interest rate of 13% on this program for one of their credit lines. Well, all they have to do is go interest-free for 12 months, then call up the lender in the 12th month and say, look, I love you guys, but you're at 13%, and I've got other credit lines at 7 or 8%, and if you can't play ball with me, I'm simply going to stop using your line, and I'll just use those other lines that have much more competitive interest rates. And they're going to say, sir, you've paid on time for 12 months. We don't want to lose you as a customer. Effective tomorrow, your rate's going to be 8% or what have you. So all the unsecured debt that they have on this program typically is going to be in the single digits, and I'm sure you'll all agree with me that for unsecured debt, those are really good rates. Now, no hits to your personal credit. As I mentioned, all of these unsecured business lines of credit do not report to your personal credit at all. They report to your business credit, okay? So that's important. especially important for guarantors or co-signers, for example. You can assure them that their credit is not going to be tied up long term if they will agree to lend their good credit to help their clients or your clients. The only thing that winds up on a credit report is the initial inquiries from the lenders that we select for you. Lower rates if you pay on time and larger lines if you pay on time. For example, let's say we have a typical client who only qualifies for a $15,000 line of credit. Oh, and let me cover one thing here. Most of these lines of credit max out at around $25,000 per lender per client, okay? So that means if a client asks me for $100,000 in lines of credit, even if they have really, really good credit, they're typically going to have 4 to 6 lines of credit to make up that $100,000, okay? So if the average client, for example, only qualifies for a $10,000 or $15,000 limit on their credit, so what happens there is 6 months from now or 1 year from now, if they've used the lines properly, and we'll advise them on what that number is, how to use them, then they can go back to the lender and ask for an increase in their credit lines, and most of the time the lenders will grant them that increase. So they could actually get lines, let's say, that total $40,000 or $50,000 from us initially, and turn it into $100,000 in lines of credit in the space of 6 to 12 months if they manage those accounts correctly. Okay? So larger lines if you pay on time, absolutely. New corps and startups are okay. Another great benefit to this type of funding is the ability to improve a client's personal credit profile and score. In many cases, what I find is that my clients are carrying business debt on their personal credit cards. And as we mentioned before, carrying an excess amount of debt on your credit cards causes your score to go down. So once the credit lines are granted, it's easy to move that debt onto the interest-free cards, the business lines of credit, if you will, relatively quickly, and that dramatically improves the client's personal credit profile and scores as well. A home equity line of credit or other personal loan may be secured to assets in many cases, in many cases to the business owner's personal residence. So if you have a balance on a home equity line of credit, that could be transferred to the unsecured business lines of credit. Now, obviously, an individual does sign personally for these lines, okay? So if the client does not pay, there will be consequences. However, the consequences are not dramatic, like losing a car, losing a boat, having a home go into foreclosure. Because they're unsecured, basically the only hit will be to the client's credit and nothing else. Now, for example, if a lender gets a judgment against the client's credit, they can't necessarily collect on that judgment immediately. However, when the client goes to sell a home, typically a title company does a search, and if they find a judgment on the client's credit record, most lenders will require that judgment to be paid off before they receive assets from the sale of a piece of real estate. So there are consequences, but not nearly as bad as what you have on a secured mortgage or a secured loan of any kind. Okay, we talked about the fact that acquiring business lines of credit improves your personal credit, and it actually helps you build your business credit profile as well. Plus, banks issuing cards are always happy to see clients moving balances from other banks to their banks. So transferring business debt on personal cards to business cards will strengthen both their personal and business credit profiles and credit ratings dramatically. Definitely true, definitely true. Okay, based on thousands of transactions, we know which lenders access which bureaus and which lenders report only to Paydex instead of your personal credit, and which lenders offer 6 to 12 months interest-free periods to their clients. So, for example, we do not, pardon me, we do not do business with Capital One because Capital One, even though they're one of the largest lenders out there, insists on reporting their clients' business credit lines to their personal credit profile, and that does not benefit a business owner who needs to use that line for business. It needs to be reported to the business credit profile because it can have a dramatic negative effect. As I mentioned before, when that client maxes out a credit line on their personal credit, the score can drop dramatically. 50, 75 points is pretty common, even if the client is paying perfectly on those credit cards or on those lines of credit. Okay, so it's much better to have the business credit show up on the business credit profile. Okay, we have 12 months interest-free for all the clients. Again, we mentioned that before. Okay, and here are examples of lines that I've actually received myself. So you know that this is actually a real live thing. You'll also see that these lines of credit are granted from a wide variety of lenders. American Express is one, U.S. Airways is one, serviced by Elan Financial, Chase, typically Bank of America is involved. So we do business with about the top 50 or 60 lenders out there, and they all have basically different programs that they follow. For example, most lenders only pull one bureau, for example. So in many cases, if we have a client that has a lot of inquiries on Experian, for example, but very few or none on TransUnion, it's possible to steer the client to that bureau that does not have too many credit pulls. So that's another advantage of our program. Okay, let me go back one time here. There we go. Okay, let's cover types of credit again briefly. The types of credit, typically what happens there is you have mortgage loans, you have credit cards, you have installment loans like car loans, furniture, that sort of thing. That benefits the client. Mortgages usually indicate stability, okay? So it's quite possible if a younger client, for example, has a car loan and a couple of credit cards, when they acquire a mortgage, their score actually goes up because it indicates stability. So that's another issue. We also covered new credit, okay? When a new credit is available, again, they should only apply for credit once or twice in a 6-month period. Another interesting thing about that is that when they apply for credit, when they get a copy of their own credit report themselves, like going to creditchecktotal.com, which I mentioned earlier in the webinar, that's considered a soft pull and does not count against their credit. When I, as a mortgage professional, pull their credit, or when they apply for a credit card, or when they apply for a home loan, or when they apply for an auto loan, then those types of credit pulls are considered hard pulls. When I teach that credit class, one of the things that students commonly slap themselves on their head because they say, well, gee, you know, that's happened to me, okay? And what I'm talking about is when you go into an auto dealer, for example, to apply for credit, typically what happens is that the finance manager wallpapers the city with your credit report. He sends your application to 8 different banks, and it's common for you to wind up with 8 different credit pulls all in one day or all in 1 week on your credit, and that obviously causes your score to drop quite a bit and is a real bad thing. So knowledge is power. Everyone should have a copy of their credit report before they ever go into a car dealer or before they ever make any other major purchase like a home, and have a professional like myself analyze it for them if they're not familiar with it, to make sure that they are going to qualify even before they go in. When I go in to buy a car, and if I'm going to finance it and I talk to the finance manager, I tell them, look, you got 1 shot, okay? Pull credit from just 1 location, and if that doesn't satisfy you, then we can't do business. If I find out my credit report has been wallpapered all over the city, then I'm going to come back and I'm going to really complain, okay, because that's really causes a major problem. We talked about the fact that you know, the amount of credit pulls definitely affects whether the underwriter is going to approve you or not. Even in a mortgage situation, if an underwriter sees 10 credit pulls, even 5 credit pulls in the recent past on your credit, they're going to make you document every one of those credit pulls and what happened. In other words, was credit granted? Because obviously that's going to affect your ability to repay the mortgage loan if you have additional monthly payments to deal with as well. So that's the end of the credit report, or the end of the webinar, and I'd like to thank you very much for attending. There's all my contact information. I would encourage you to get in touch with me to ask any questions that you might like, and of course if there's any questions at the end of the webinar, we'd be happy to answer them as well. Okay, Andrew, I'll turn it back over to you. We can give them the last number.
All right, thank you so much. The last number is 79. Again, the last number is 79. And like Ray said, I don't see any questions right now, but like Ray said, he's got his contact information up right there if you need to follow up with him for any additional questions or anything you might have to comment for him. So with that being said, Ray, thank you so much. I appreciate it. Thank you everyone else for attending today. That concludes today's webinar.
Take care, everybody.